for joining us to talk about JPMorgan Europe Growth and Income, or JEGI for short. I actually have a number of slides here, but there seems like a good appetite for asking questions, so I'll give the abbreviated version and leave more time for questions at the end. Roland, if you wouldn't mind skipping forward one slide, and we'll start with a quick overview of the portfolio. So I'm Tim Lewis. I'm one of the portfolio managers on the trust, working alongside Alexander Fitzallen-Howard and Zaina Shuhaber, who you see pictured in the slide. Alexander has been managing the portfolio since the early 2000s, and Zaina and I joined him on the strategy in 2020. So what is JEGI? JEGI is constructed to be a core portfolio of European companies, excluding those listed in the UK. And ultimately, what we are trying to achieve from the portfolio is consistent and risk-controlled alpha generation. So it's one that we believe can outperform its benchmark in different market cycles, whether growth markets are working or value markets and up and down markets. It's not determined by specific sectors. And we think that's reflected in the performance on the right-hand side. So you see NAV outperformance versus the benchmark of 2% per year last year, 3-year per annum, 5-year per annum, and the share price excess return in excess of that as the discount is narrowed. And also we seek to utilize our investment trust structure. So both in our use of gearing, as you'll see, at around 5% today, but also through our enhanced dividend policy. And what this means is that we commit to a 4% dividend yield based off NAV at the start of the year and paid quarterly. And so importantly for us, that can be paid from income, from reserves, or indeed capital if needed, which means we can offer shareholders a reliable source of income without compromising in terms of our investment strategy and our stock selection. And certainly this simplifies the investment approach for Alexander, Zaina, and I, where we can be solely focused on finding the opportunities with the best total shareholder return. So if we skip to the next slide, please. How do we go about building this sort of all-weather portfolio? So our process combines both quantitative research that we see on the left-hand side and fundamental analysis. And as portfolio managers, what we're really looking to do is extract as much as possible from what we believe to be leading-edge quant research that we have at JPMorgan, and also from our global team of fundamental analysts. So, we spend as a firm $150 million on equity research. So we want to be able to dive into that proprietary insight and use it for our trust. And we believe the combination of these two is one of our key strengths. So those quantitative tools allow us to assess over 1,000 companies daily in a rigorous and repeatable way. It helps us to screen for companies that might require more fundamental work, but it also helps us to assess our own existing holdings in an unbiased and an unemotional way, and that can be really useful. On the other side, that fundamental research done at both the analyst level and at the portfolio management level allow us to dig deeper, have more stock-specific insights, and can be more forward-looking and context-aware. So if we switch to the next slide, please. What are we looking for through this process? And I think Douglas mentioned it earlier that we're all looking for quality businesses, but we are the same. And by that, we mean companies that generate good and sustainable returns on invested capital, companies where the earnings per share translates into free cash flow. And we want to invest behind management teams that we think are making sensible capital allocation decisions. And I think what's been very important over the past 3, 5, maybe longer years is that we need to assess the duration of those attributes, because it's been, as we've gone through the pandemic and the rebound out of the pandemic, with different sectors performing at different times, we found that certain business models and industries have performed particularly well or badly, but on a very short-term view. So we need to assess the duration of the quality of the business and assess it on that view. In terms of the valuation, it's important for us to work out whether the market has already discounted these prospects or the quality of the business, because it's all well and good identifying the best companies in Europe with the best outlook, but if it's already priced for perfection, then we have no differentiated view and there's no opportunity to make money. So we are looking for, where is our research showing us ideas that the market is incorrectly priced? These don't need to be the highest quality businesses in Europe. They just need to be good quality businesses that are attractively valued and maybe are a missed opportunity from the rest of the market. And lastly, in terms of the momentum, that's incredibly important for us. And this is really thinking about the companies, whether the company's operating momentum is improving. So the most important way for us to assess that is by looking at management guidance and earnings per share expectations over time to see whether they're being downgraded or upgraded. But there are also more nuanced ways when we think about those quant tools. Can we use them to assess the tone of management calls with analysts to see how that's changed over different quarters. Also using those tools to assess industry trends across companies with similar themes or in the same sector to try to catch the canary in the coal mine. It's important that not all the companies that we invest in will have all of these attributes, but overall the portfolio as a whole is always built to be cheaper than the market, have better quality characteristics than the market, and to have better momentum than the market. If we switch to the next slide, please. Very briefly on this one, and ultimately, when we bring these stock-specific ideas together, we then need to form a portfolio which balances, on the one hand, strong conviction and stock level insights, but with appropriate risk management. And to do that, we combine proprietary and external tools to view our portfolio from multiple perspectives, to manage macro exposures, to run through different scenario analysis, and all with the intention of to reduce as far as possible some of that macro noise and allow our stock-specific ideas to come through. If we switch to the next slide, please. And this is just a brief chart starting the 10-year up to the end of last year. And I think what we'd say is everything that's been said before is key to delivering these consistent excess returns that we see on the slide. So the past 10 years has been a difficult one within Europe, being macro. Notable political volatility, a global pandemic, a war in Europe that's still ongoing. We've had considerable variance in market conditions through the decade. But it's one where we have managed to generate strong returns, we believe, in an absolute sense, but also where our outperformance versus the benchmark has been consistently earned, no large spikes or drawdowns. And this is what we'll be trying to replicate again in the next decade. If we move to the next slide, please. Again, we see this balance, I think, reflected in our attribution from the past year. And so in the interest of time, I won't dwell on any one stock, but please do come back if anybody has any questions on them. But the main thing I would talk about is kind of the shape of it. The first is to point out the relative size of the yellow bars on the left-hand side. So it's more about stock selection than asset allocation in terms of our outcomes. And secondly, if we look at the stocks then on the right-hand side, our top performance at a stock level, these are companies that perform for very different reasons. So if we look at the top 5, they're coming from 5 different sectors. And we think that's a positive symptom of the balance that we're trying to get in our portfolio. Actually, if we look at the bottom, it's also true. And obviously, having these detractors is disappointing for us, but it's important that there's also no unifying thread through those names. So it's uncorrelated outperformance and underperformance that isn't linked to a specific macro or style environment. And again, why we believe this is sort of the outcome we want to see in terms of creating that all-weather performance, which has served us well in the past. And we believe, and I think our shareholders believe from talking to them regularly, that it's going to be even more crucial over the next few years. If we skip ahead a slide, please. Again, I won't dwell too much on this slide, and we can come back to the names, but I think similarly, we would look at this and say, we want our large actives to show, they want to be large enough to show the conviction of our ideas, but we also almost want people to be confused when they look at our list, because it should be a diversified core group. You shouldn't be able to identify, is this an income portfolio or a value portfolio or a growth portfolio? Because there are different stocks with very different drivers and different sectors. and that is a typical makeup of our top 10. And again, to performing in different market environments, we think that is crucial. And then on the next slide, please, Roland. But that being said, despite building the portfolio from the bottom up, despite wanting to have that diversification, there are also, there are certain themes that emerge, and often it's the more interesting way to talk about our portfolio. So we've highlighted some of these on this slide as a sort of flavor of the sort of companies that we're invested in today. And these represent medium to long-term structural growth opportunities where European companies are, we would say, very well placed to benefit, and in many cases are the industry leaders globally. So, we want to make sure we're getting exposure to these growth areas, but still in a balanced way, either in terms of the style of the companies that we'll invest in or the sectors. So if we start with European infrastructure spend, which is obviously a very topical thing at the moment, here we have a number of names, and I've just picked a few. For example, Heidelberg, the cement company, it's really at the heart of European infrastructure spend. It will be a key beneficiary of German stimulus, and it has optionality, we believe, on potential rebuild of Ukraine if we do see a ceasefire and an end to the war there. And ultimately, this will lead to higher market growth. We think incremental pricing from higher utilization rates and the potential for energy price declines, which is a key input cost for the business. There's also Siemens, German industrial bellwether. It's probably very obvious why that will be a beneficiary of German fiscal stimulus. But importantly for us, this is a portfolio of businesses, sometimes to its detriment in terms of being a conglomerate, but it includes both short cycle, that will be exposed to that improving industrial data in Europe, but also longer term thematics around electrification and industrial automation that, is a name that we would want to own regardless. And we did own it before. And then SPIE, a lesser known name, it's a multi-technical services business. So really what that means, it's a engineering consultant and services business. So, planning through to execution of infrastructure projects. So again, very obviously a key beneficiary of the sort of 500 billion special fund for industrial and infrastructure investments over the next 10 to 12 years. And it's a French business, but 35% of its revenues come from Germany. And we don't expect the sort of stimulus to be limited to Germany anyway. In terms of the center point there, the interest rate normalization, that's something that Joe just talked quite a bit about, and it's a key position in our portfolio as well. And that doesn't come from a starting point that rates need to go higher from here, or even that rates need to stay where they are, but rather the past 10 to 15 years since the global financial crisis has really been a very difficult environment for European banks, both with regulatory pressure and also from a seemingly one-way slide for long-term interest rates. And they are probably one of the winners from the pandemic in that we have now seen a rise in inflation, and long-term inflation assumptions have been completely rebased. And because of that, we see a sector emerge for much stronger capital again, something that Joe mentioned, and the potential to generate strong returns in an environment where rates stay between 2 and 2.5% in Europe. And I think with that case, the sector still looks extremely cheap at around 1.2 times book value. And we still got a number of names doing around 15% of market cap in shareholder returns. And it's been phenomenal performance from the banking sector. I think this quarter has just marked their 18th consecutive quarter of beating expectations. So this hasn't been a flash in the pan. This has been a steady build of continually beating on very low expectations. And that's often a really good opportunity for us as investors, is when expectations are low and when things are improving, and we believe will structurally stay improved. And lastly, on this page, I've put the resilient consumer. So here we've got Adidas, still seeing double-digit organic growth and a margin recovery, boosted by the sort of brand heat in their terrace shoes, which probably people see all around the place, and also weakness from their main competitor, Nike. There's Carlsberg, where we think the worst is probably behind them in China, and where they're at least seeing share gains. And I think also the markets maybe underappreciated some of the changing mix towards soft drinks with their acquisition of Britvic. And also it's with some gross margin expansion still to come through. And then lastly, we like to always put in a small cap name that maybe people haven't heard about. Doe & Co is premium catering for airlines and events. And essentially the story behind this is as pricing for premium events like business class and first class airline seats or to attend sporting events, as the pricing has risen, so too have the expectations. And so coming in at a premium level, with it being fresh food on airlines or just better quality food at event catering, has seen them win an extraordinary share against competitors that are over leveraged. I think the key to their success we see in how many airlines are signing them up. They're in every Formula One paddock, Champions League finals, FIFA World Cups, UEFA Championships, everything. So we are seeing a very small company with a great a tailwind behind them. So before moving to questions, I'll just kind of one more slide, please, Roland, just to finish up. And I think we believe there are three key features really that distinguish this investment trust. The first is our disciplined, repeatable investment process. That the harnessing both quantitative and the fundamental analysis. And we think that has been crucial in generating the returns that you see on the top left of the screen, with the NAV up over 140% over the past 10 years. The second is how that track record has been built in different market environments. And we believe this is something we're seeing shareholders come to us more, maybe talking about some of their other experiences, or maybe just appreciating it more in volatile market environments, how we've been able to outperform in both up and down markets at times when different styles have led the market, be that value or growth or different sectors. And then thirdly, it's that enhanced dividend policy. So it's offering a reliable income stream without compromising on the return potential of the portfolio as a whole. So I will finish up there and open up to any questions, please.
Okay, Tim, thank you very much indeed. Okay, kicking us off, first question, and we haven't mentioned him yet, but here we are. Mr. Lewis, topically, how do you see Trump's shenanigans playing out, both for Europe and for other markets?
Yeah, I should really be prepared for these questions, but I find it hard to have an answer because it's hard to prepare. The way we have seen Trump for the past 12 months, so not just now, is that it's a risk to try to control within our portfolio, because it's very difficult for us to it's very difficult to anybody to know what Donald Trump is going to do next. Is my open belief, and so we've been using it really more as a risk control. But I think obviously then for the wider market, what we have seen over the past few weeks, especially, is that the idea of US exceptionalism as an only positive thing seems to be reversing somewhat, and I think we're seeing an interest coming back into the European markets because of I'd say the uncertainty in his policy. So if we look at, for example, you can see policy uncertainty indices, and they're spiking to all-time highs in the US. And I think markets don't like uncertainty, and that's going to play against them in the US.
And further to that, tariffs, so someone's favourite word. How is the portfolio potentially exposed to tariffs, if at all?
Yeah, we're not particularly exposed at the very sharp end of it. So, in terms of autos and spirits, but I think that the tentacles of it you'll never quite avoid completely. We do have some exposure to luxury goods, some areas of industrials. But again, I think on the whole, especially relative to the benchmark, I would say we are well positioned. And again, there's still so much to be. Donald Trump considers himself the deal maker, so there's still deals to be made on it, and there's still upside consequences, because a lot of our companies are operate in the US and have onshore activities in the US that might benefit from pricing, or we might see reciprocal actions. So it's definitely something that we think is completely one-sided, but we have been managing the risk for quite a long time, actually.
And next question has asked about company management. Do you go out and meet all the companies in your portfolio? You seem to have quite a technical analysis. Are management teams important to you as well?
Yeah. So we wouldn't necessarily say, it wouldn't be that we have to have met them always before, but probably 98% of our portfolio or so, we've probably met management. Certainly all the large cap names we're meeting regularly. We also have a small cap team here who, if we aren't meeting the management, our small cap team likely are, and we're using them to funnel ideas to us from a very successful European small cap franchise that we have. And it is important. We don't, we still like the combination of quant and fundamental because that takes us away from those emotions and the biases that can creep in because it's not just one sided. Meeting management can lead to sort of management capture as you come away from meetings thinking, believing everything that's said. So we try to, we try to balance the two basically, and we think that's important.
And again, and another theme we've had from earlier presentations talking about defence and investing in defence. How's that played out for your portfolio? The announcements we've seen for European nations increasing their defence spending, are you exposed to that?
We have very limited exposure. It's been a drag for our performance. It's kind of something we've got wrong. Not to have more. We own Safran, which has some defence exposure, but we haven't owned names like Rheinmetall and BAE and Leonardo names. That very more higher beta to that theme. I think we've probably wrongly assumed they were too expensive for a very long time. But with most of these things, they look expensive until the earnings catch up with it, and so it's still something we debate. We've just continually been late on it, I think.
Okay. I've got a couple more quickies here. Firstly, how many stocks in the portfolio?
87 today.
And is that a typical sort of number for you, Tim?
Yeah, that's typical, and I think and that can be a range, but the reason why that's probably higher it's towards the slightly higher end is because we have a bigger exposure to small cap. So we have around about a 10% exposure to small cap, and typically when we're invested in smaller companies, we're invested in more of them in smaller size, if that makes sense. So it kind of adds to our name count.
And how small do you go down to? Do you have a market cap threshold that defines your universe?
Yeah, it's more to do with the liquidity of the stock. Doneco that I mentioned there is about a 2 billion market cap. We could probably go lower as long as the liquidity is good, but it all feeds into our kind of trading decision making that comes around based off the liquidity.
Lovely, Tim. Thank you very much. Thank you for joining us this evening.
Thanks, Ron.